In this paper, we provide new and more robust analysis of scope economy in the post-29 U.S. commercial banking. The analysis used the most recent data, accounts for banks' non-traditional operations, and improves upon the prior literature in multi-methodological ways, including employing the methodology that is more robust to excessive extrapolation. We estimate a flexible time-varying coefficient panel data quantitative regression model, which accommodates three-way heterogeneity across banks. We found strong empirical evidence in support of significantly positive scope economy across banks of virtually all sizes, and contrary to earlier studies, we found no material evidence in support of scope diseconomies. The motivation of this paper is that the Dodd-Frank Reform and the Consumer Protection Act of 2010 seek to eliminate the too big to fail doctrine by setting restrictions on the scale and scope of bank operations, which may limit banks' ability to capitalize on the potential cost savings associated with operating at a large scale with a more diversified product scope. And large banks may derive such efficiency benefits from their ability to offer financial services at lower average cost due to scale economies driven by the increasing returns to scale, as well as scope economies via input complementarities and positive spillovers. Existing empirical evidence lends no support for product scope-driven cost economy in banking, but is greatly outdated, and there has been little research on this subject, despite the drastic transformation that the U.S. banking industry has undergone over the past 2 decades, particularly propelled by the recent financial product innovations involving derivatives, securitization, and mortgages. Banks are becoming more complex, branching out into many non-traditional off-balance sheet operations. This broadening of operational scope in the pursuit of revenue diversification may be beneficial if banks exhibit scope economies. In this paper, the bank level data come from reports of conditional and income and uniform bank performance reports. The sample includes 40,000 observations for 7,000 banks. The two traditional outputs are total loans, total securities, and we use the sum of credit equivalent measures of various balance sheet activities as a proxy for banks' involvement in non-traditional activities. The three variable inputs are physical capital, labor, and total borrowed funds, and we also include equity, ratio of non-performing assets to total assets, ratio of loan loss provision to total assets to control for banks' insolvency risk and credit risk. And we estimate banks' time-varying translog cost function at different conditional quantities of cost. By employing a quantile approach, we are able to capture distributional heterogeneity in the bank cost structure. In addition, we let the coefficient of this translog model be time varying to account for temporal variation in cost complementarities and spillovers due to technological change or innovation. We also control for unobserved bank heterogeneity. A bank is said to exhibit scope economy if its average cost is decreasing in the number of outputs or operations. To test for scope-driven cost savings, we use an expansion path measure of cost subadditivity, for which scope economy are a necessary condition. The subadditivity measure relies on comparison of the cost of smaller multi-output banks of differential degrees of specialization with the cost of a larger, more diversified bank. Specifically, we use ways to generate three counterfactual banks. Each bank has differential degrees of specialization, and the quantitative measure of cost subadditivity is the difference between the sum of costs of three counterfactual banks and the fitted cost of actual banks divided by the latter. The value of subadditivity depends on the choice of distributional ways. To test for scope economies, we adopt a conservative approach to measure cost subadditivity, whereby weights are chosen such that the corresponding subadditivity is the smallest. So if the smallest subadditivity measure is still positive, then one can quite safely infer that scope economy are locally significant over the bank's output space in a given year. Table 1 summarizes such point estimates of scope sub-additivity for different quantities of the conditional cost distribution. Each bank year is classified as exhibiting scope economies or non-economies and scope invariance versus scope non-invariance, respectively. The right panel reports sample shares for each category and for its corresponding alternative. So we can see that the mean estimates of cost sub-additivity range from 0.138 to 0.459, depending on the conditional cost quantile. This suggests, on average, the potential for 14 to 46% cost saving if the bank rebalances its joint production of loans, securities, and off-balance sheet outputs. Even at the very bottom of the cost condition, our test results suggest that a majority of banks enjoy scope-driven cost savings. And Figure 1 provides the kernel density of cost sub-additivity estimates across cost quantiles. Consistent with results in Table 1, Figure 1 indicates that large-scale banks lying in the upper quantiles of cost distribution appear to enjoy diversification-driven cost economy than those in the lower cost quantiles. And our results are also robust to measuring of balance sheet items using non-interest income minus service charge on deposits. Our results are also robust to considering 5 outputs by disaggregating total loans to consumer, real estate, and commercial loans. That's it.